Our next guest grew up in Uganda and started his investing career at the age of 12, arbitraging the price of chickens. Join us as we trace his career through the radical candor of being a partner in Bridgewater to being an early member of a new outsourced CIO and now as the founder of his own firm focused on the African investment opportunity. I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Richard Okello, who is CEO and co-founder at Sango Capital, an investment firm he founded 10 years ago that has a particular focus on investing in Africa. He previously was a principal at Makena Capital, and prior to that in a series of roles at Bridgewater Associates. Welcome, Richard. Thanks for joining me today.
Very happy to be here, Aoife.
Well, let's start with your background and career journey. Can you tell us where you grew up, what you studied, and how ultimately you came to enter the world of investing?
So I grew up in Uganda, in East Africa. I was fortunate to get a scholarship to the United Kingdom for high school and another scholarship to Swarthmore College in the US, where I did my undergrad. I think the world of investing for me, though, really started with a small business venture at age 12. I had a small chicken business, essentially price arbitrage on chicken when I was 12. And that really got me interested in making small investments and making a return. But that was also quite colored by a family history that was very big picture, very macro. So my dad, for example, worked for the Uganda Central Bank for a long time. We were reading The Economist basically in our early teen years and so on. So that history together helped me decide on a degree in economics and eventually led me to Bridgewater, a macro-focused hedge fund.
Well, I have to dig in just a little bit more onto that chicken business. Can you just tell us exactly how you discovered this arbitrage? What kind of a market was it? Your local market vendors? And how old were you at the time?
So I was 12, and there was an interesting dynamic back then, which was that information arbitrage could be very, very high in Uganda, right? So you didn't have cell phones. You had a select set of landlines. And so the price of products, the farther away you are from the city, varied very dramatically, right? So you could essentially buy chicken, let's say 5 hours out of the city, put it on a bus or whatnot, and then get it to the city and sell it and make essentially 100% profit on it, right? Just because the two groups of people just didn't know what the price was. And so in summary, that was the business. And so, during the holidays, my family would take me up to where my dad grew up. And on the way back, we would essentially, I'd just buy some chicken, stick it in the car, bring it out to the city and sell it.
So you mentioned moving to Bridgewater. Can you speak about some of the moments maybe throughout your career at Swarthmore that led you to a firm like Bridgewater?
So that's a great question. So I'd actually start at high school. I'll highlight a couple of things. So at high school, my high school economics professor was a gentleman called Andy Kumalo from South Africa. And he had a very interesting history. I won't get into that. But essentially, he'd sort of escaped apartheid. He was Amnesty Prisoner of the Year. But the thing that really stood out was he had this unrelenting desire to basically get his students to think as economists. So he was a very non-conventional professor, very, very practical, really pushed us. So that was sort of the first thing, I think, in high school that really got me interested in economics. I think the second thing then was my actual decision to attend Swarthmore, which could only be described as sort of divine providence, I think, in summary. It was a very atypical decision. And when I got to Swarthmore at the time had a very, very strong economics program. Economics professors are quite storied. Actually, one of my professors, I think, joined the Federal Reserve Bank as one of its governors just a couple of years ago. So I think that was the second thing that had an impact in terms of the focus on economics. And then the third was, while I was at Swarthmore, I spent a summer in Uganda at a very critical time. Uganda then was starting to privatize state-owned assets and was also doing the advanced work on setting up a stock exchange. And I was fortunate to get basically drafted into both teams. It was a very busy summer, but I worked with the team that was doing the privatization of state-owned assets and for half a week each week. And then the other half week was spent with the guys working on setting up the stock exchange, right? So taking theoretical economics into a very practical construct like that in a country that was emerging from a lot of chaos, I think became very instrumental in how I started to think about opportunities.
And then moving to Bridgewater. So Bridgewater is quite known in investing circles for its very unusual, unique culture, particularly around radical candor, giving frank feedback. It's not an environment for everyone, but those who do thrive there really thrive there. Can you talk a little bit about how you found that environment? Did it speak to you in some way? And maybe what you've taken from it now that you're running your own firm?
It's a great question. So I think the Bridgewater culture, which is now well known globally, I would describe it as a culture that's not for everyone, actually. So this idea of radical candor, for example, only works with people who are or can get comfortable self-examining themselves, facing their weaknesses head on, and essentially using those weaknesses to fuel improvement. I was always that way. Just before I ever joined Bridgewater, I was that way when I was in middle school, in high school. In middle school, for example, we had a practice of caning at school, and I just thought that was wrong. And I didn't stop there. I kind of chased it down till we got it turned around and abolished. And so this idea of being able to face your own weaknesses or weaknesses of society around you, if you are like that, then you thrived at Bridgewater. I think that was part of it. But Bridgewater also had this notion which they defined as the pursuit of excellence. So at the time, it was defined as excellence at all costs. And I think that really spoke to me because I had seen firsthand from a young age what could happen if you try to do that, just how much more you could get done with your life if you try to do that. And so I think those two things together helped me thrive there. Now, have I taken some of those ideas with me? Yes, I did. I took them to Makena in how I thought about the teams I worked with and what I did there. One of the things, for example, that I wanted to try to get done at Makena, which I pursued aggressively, was this notion that investing for a global multi-asset class endowment should not be restricted to asset class thinking, right? So a lot of things fall between asset classes. How do you open up that space in a large institution and really get ideas flowing that could be cross asset class that might otherwise fall by the wayside? But as I set up Sango post Makena, I've certainly taken those ideas in as well. And those ideas affect the types of people that we hire here, the way we think about running the farm, the way we run the farm, and also the way we self-examine as the leaders of the farm, which I think is the best way to lead the farm, right? So having people see that we can self-examine ourselves and make changes as needed.
Really interesting. Well, before we move to Sango, I just want to circle back to Makena briefly, because I think it's interesting what you mentioned about your not too strict asset class thinking. That was a breakthrough business model at the time, Makena Capital, when it was developed. And I would completely agree with you about not being too siloed in how we approach thinking. I think that was something I was a proponent of at my own firm back almost 20 years ago now. And how do you think that the outsourced CIO model will continue to thrive over time? How will that continue to evolve?
So I think the outsourced CIO model, as with all business models, has got to be demand driven. So when Makena was set up, those clearly demand for outsourced investing. In fact, Makena's very idea came from a number of very large global investors coming to the team at Stanford and asking them to run their assets, right? So there's demand there. So I think, obviously, the model has evolved quite a bit, but I do think that the demand for the model is informed by three things that, depending on what happens with those three things, I think you start to see evolution. So what are those three things? I think one is you've had this unprecedented historical wealth creation globally. Lots of high net worths globally, lots of institutional wealth creation, a lot of that obviously through the central bank interest rate path that we've had for the last 2 decades. Obviously, that's reversing a little bit now, but I think once you have a lot of liquidity and wealth, there is a demand for that to be managed. 2, you've also had what I describe as rising global variety and complexity of investments. I mean, life has obviously evolved dramatically over the last 30 years from lots of institutions, lots of individuals, mostly investing in public equities to private equity, venture capital, lots of other things that are now kind of standard, as well as very complex instruments. And so as long as that complexity exists, you will have wealth owners who do not have the time, the bandwidth, or the interest in understanding the complexity and need to outsource that to others. And I'd say the third thing is sort of the limited access to the best investment vehicles. So the supply of wealth far exceeds the supply of high quality return driving vehicles, right? Whether they're funds or others. So you put those three things together, I think the OCIO model then has demand. Now, how does that demand evolve? I think, for example, if you take limited access to investment vehicles, that access used to be inconsequential to individuals, right? Individuals never really invest in private equity. Now they want to invest in private equity because they can see where the returns are. And so one way in which I think that model will need to evolve is that it will need to evolve towards this general trend of democratization of public access to the best global return providers. And if it could do that, then I think that becomes very interesting for the model. Those that do that as OCIOs, I think will thrive, and those that don't will probably stagnate. I think the other way in which that model could evolve is that if that model starts to simplify the complexity that exists. So, for example, we get questions all the time about investing in Africa. Even institutions, sophisticated institutions, struggle with how to think about the geography. OCIOs can obviously step into that, simplify that, and aggregate that demand into a supply construct. And so I think if the model evolves to simplify what's complex and make that available to lots of people, then the model will be very strong. If it doesn't, then I think other models will get created to do that.
Really interesting. And speaking of access, then I'd like to segue to Sango Capital, because I'd love to know how that idea originated and what led you to strike out on your own.
So I think that idea started probably before I actually ever left Africa. I think the idea of doing something in Africa, when you are in a region physically, you get to see obviously opportunities and risks. And I happened to grow up in Africa at a time when Africa was changing very, very quickly. A lot of the instability that was historical started to dissipate. We started to see wealth get created at rapid rates, but that was years and years ago. So I took those observations, and as I went to the US, worked at Bridgewater and at Makena. At Bridgewater, we did very modest investing in Africa. I think in the first year that I was there, we did some currency investing, and then the market just wasn't big enough for Bridgewater. At Makena, I started a process of looking at Africa. And so I think as I traveled more to Africa, I started to see the ideas that had been nascent when I lived in Africa really take shape. I started to see lots of investors and investments get done. Investors come to the region. Investors who are in the region get a lot of interesting things done. People I went to school with were doing phenomenal things. And so the idea of bridging North American capital into Africa was really born from that observation. And then as we started to do that, we set up this business just about over a decade ago, about 11 years ago. The acceleration that has happened in Africa over that period is just shocking, like positively shocking, right? The amount of demand creation. When we started investing here, for example, you had probably, maybe 60 or 70 or 80 private equity funds. So today there's close to 300. That's just been a decade, right? And so when you see that type of transformation in an industry, but also in the underlying demand, the number of people with access, with cash, with cell phones, and so on, that's just a very exciting environment to be in.
Well, let's talk about that investment opportunity, because you mentioned that you've always perceived it. It does seem that there was a phase when Africa was a very hot topic, say, maybe among Makena Capital clients or among other forward-thinking institutional investors. Then we saw the flushing out of some emerging market investments because of the poor performance, maybe a risk aversion, increased geopolitical concern. Obviously, China is a big investor in Africa. Can you speak about how you think the African investment opportunity is perceived today? Is it perceived as frontier? Are there misperceptions there?
So I think the range of perceptions about the opportunity is incredibly wide. Well, why do I say that? So let me just start with, let's say, our clients. In our client base, we have institutions that are really stepping into the African opportunity, i.e. they are building 10-year plans to scale into Africa across different asset classes. We're helping them do that in some areas. They're doing that themselves in other areas. And the others who are still dipping their toe in, right? And these are all sophisticated institutions. So the difference is not the level of sophistication, right? So those are people that are investing here. Now, if you talk to people that are not investing here, the range of perceptions or misperceptions is also very wide, right? There are people who are not investing here because they think of Africa almost as they do a country, because most of what they've done globally in terms of investments has been around a country, like the US or certain countries in Europe, specific countries, or China. And so if you think about Africa in that lens, then you just are completely off the mark, because it's a very complex collection of 54 countries that are vastly, vastly different. So I think that's one misperception. I think the other misperception is a risk misperception, which is that the reporting of risk globally, but certainly in Africa or about Africa, is always backward looking and is quite delayed relative to reality. Just give you one example, right? So I recently spoke at an event where they asked me about political risk. The person that was doing the interview said, look, lots of people worry about political risk in Africa. And so then this was my response. I said, look, I look at Asia and I see a China that's saber rattling about Taiwan. There's a war in Europe. The US kind of left-right split is at extremes. And then there's Africa. So tell me what political risk you're worried about in Africa, because the elections are happening just fine. And, Africa is kind of just going on its merry way, right? Now, that's not the whole continent. There are countries that are quite volatile, Mali or Burkina Faso or whatnot. But some of those countries are so far from where investors are. To get from where I'm sitting right now, which is South Africa, to Burkina Faso is probably 7 hours flight nonstop, right? And so it's so far away that it actually doesn't really matter to us here what's really going on there, right? And so I think the second misperception is a misperception that's driven by information that's backward-looking, generally aged relative to the pace of change in the region. Now, having said that, I do think that people are waking up to the fact that Africa as an investment opportunity is generally not picked over. You haven't had large amounts of capital flow into Africa. You've had some, but not large amounts of capital flow into Africa. You've had some people make money in Africa if they've been good at picking their return streams. The place still remains fairly uncorrelated to what's going on globally. You've had a huge global downturn in public markets, in venture capital, et cetera. In Africa, that hasn't quite been the case. It has been the case in public markets because public markets in Africa are very illiquid. And so they're susceptible to the global risk on, risk off trade. But I think in private markets, you haven't seen that as much. Valuations here have always been very reasonable. So you haven't seen that fall off. So I think as people continue to wake up to that difference, you will see a new perception of Africa emerge where people look at it as an interesting investment opportunity, albeit still emerging or frontier.
And specifically, so what are people missing? What excites you most?
I think what excites me and what excites us here at Sango is the rate of demand formation, right? So in Africa, you basically have an African consumer that was ignored for the longest time. Like basically multinationals would not provide what the local African consumer wanted because the demand of that consumer was unlike most other regions they were in. It's frequent, it's small amounts spent quickly, it's in places that might be hard to access if you sort of have a general distribution model. But the demand creation was there, and it's been really driven by, what's going on from a demographic standpoint. Everyone knows about sort of the demographics in Africa. Very, very attractive demographics, young population, lots of new family formation, a crazy amount of urbanization. I mean, there are construction cranes like everywhere. There's very few cities you go to in Africa that do not have just a massive amount of real estate construction for homes, for business, schools. You have lots of private schools where kids don't even have dorms. There's not enough dorms, period, right, for them to go to school. So I think you've got a lot of demand formation that runs into a shortfall of supply of goods and services. And so that generally creates a very rapid growth rate for middle market businesses across most sectors. So it's, for example, it's not unusual to find businesses that are growing.
And to what extent does ESG factor into this? There is a saying that Africa will be the next frontier for sustainable investing.
I think ESG is probably another misconception that people have around Africa. So ESG in Africa, I would say, is probably 10 or 15 years ahead of every other geography in the world. And that's like a crazy statement to make for most people. Then they can't understand how that could be. There's a simple explanation, which is that private investing in Africa, especially institutional private investing, let's say you take private equity, has been driven historically by development finance institutions. The IFC, which is an arm of the World Bank, the CDC, which is sort of a commercial arm of the British government that invests across Africa into commercial businesses, etc. Those groups have always had ESG considerations front and center. So the ESG behavior, benchmarking, practice, service provider regime in Africa is very, very robust, very well developed. The transparency around ESG is, like I said, is quite ahead of where most of the rest of the world that's now focusing on ESG is. So I think investors who invest here can expect that they will find not just interesting return opportunities, but that if they are particularly focused on ESG or ESG is important to them or impact is important to them, then they will have that landscape pretty well mapped out in Africa in a way that's attractive.
And just one more question that's kind of bracketed under ESG often, and it is a kind of recurring theme in this podcast series, which is around diversity in this industry we're in. Now, you're in South Africa right now. We're recording this when you're there. But I'd love to hear what you thought of the diversity that you experienced when you worked in the US within finance and investing. Any comments or thoughts from your side?
So when I worked in the US, diversity was not, well, let's split the diversity, right? There's racial diversity, there's gender diversity, and you could think of other diversity, right? So racial diversity, I think in the US when I worked there, back in the day was abysmal at best, right? It's certainly improved quite a bit in the US, although there's quite a ways to go. I think gender diversity wasn't much better, but it was better than racial diversity depending on the firm you worked for. And I think that's become much, much better. Still not quite where it needs to be. So, for example, if you think about, well, how many venture firms are started and run by women, or how many private equity firms started and run by women that have been around a long time and or people of color, that's still a very, very small percentage, right? And so those are some metrics that you can look at. I think there is focus on it in the US. I think it seems to me to be getting better in the US. I think here in Africa, racial diversity is generally not an issue, but gender diversity has been an issue, actually a big issue that has needed a lot of work. You are starting to see some real movement there. I mean, now you can point to firms in the private space that are either run by women or started by women, even in a younger industry like venture capital that's much younger in Africa relative to, let's say, private equity in Africa is, I don't know, over almost 40 years old. Venture capital is pretty young. You can still point to firms that are started by women that are good firms, right? And so I think gender diversity is evolving here positively. You are starting to see more women on boards of directors of companies. I think where gender diversity here has been historically strong in the last, let's say, 20 years has been in government. I think for whatever reason, lots of countries here have got a very strong gender diversity in government, lots of ministers, lots of vice presidents, and so on. You've had presidents, etc. So I think in government, that's been quite strong. It just hasn't been as strong in the private sector.
And it's interesting, just like in so many other areas of Africa, there is a leapfrogging going on, such as around technology, and mobile payments is a great example.
Yeah.
One would hope that there's an opportunity to leapfrog some of these probably legacy problems with how industry has been set up as well, because one would hope that that is also an opportunity, as far as I mentioned, a blank slate there as well. I'd just like to move on now, going back to some personal reflections. So you've had an extraordinary personal story from those early days of chicken arbitrage. Have there been any setbacks, challenges along that way, or even investment mistakes that you've learned lessons from?
Of course, right? I mean, I've never run into anyone that's done a lot without facing lots of setbacks and challenges. I have had several. So, for example, when I was 18, my parents were separated, but my biological mom passed when I was 18, my first semester in college, and essentially left me her 3 daughters as full guardian. So that was a setback that actually became quite instrumental in my life because it meant that I sort of didn't screw around in college, right? I just got on with it, did my classes and worked to make sure I paid for them and so on. But I think, I use that one example, there've been others, but I think those sorts of things for me they helped sharpen this notion that you must never waste a crisis, right? It sounds like sort of a throwaway statement. Lots of people use it, but the sorts of things that are brought into very sharp focus when you have a crisis kind of fall into 2 camps, right? There are things that can essentially bring you down, and there are things that can give you a new perspective on what's possible. So when you have these sorts of crises and you say to yourself, as in this example that I gave, okay, well, I'm now going to parent these 3 kids, and I'm a kid myself, I'm in college, I got to get it all done and graduate, and I go to Swarthmore, which is not an easy school. You just think differently about everything. You think differently about how you spend your time. You think differently about how you focus. Your ability to push yourself is stretched beyond what you thought possible. There was one semester in Swarthmore, my first semester, where I took 7 classes, right? And I passed all the classes. And if someone had said to me that I would do that at the beginning of the semester, without the crisis, I'd have said, not a chance, right? So I think that's been my takeaway, which is if you think about those sorts of setbacks as real opportunities to power ahead, you accomplish much, much bigger highs from those crises. If you don't, then you could spiral downwards pretty quickly.
Yeah, it's really interesting. I definitely think that they talk about private equity companies having the discipline of debt in order to make them work that bit harder, and having certainly the discipline of parenthood, and maybe that's a premature parenthood, is definitely something that would make you work a lot harder. Moving then, obviously that's an extraordinary circumstance. When you moved into your career, what would you say were some of the high and low points there? You've been in many different organizations. You've also started your own firm.
So just thinking here, I think high points, right? High points, I'd say I joined Bridgewater and I was essentially made what would have been the equivalent of a partner, I'd say 5 years in, which was kind of crazy. In fact, my reaction to it when Ray Dalio called me to a room and said, hey, here's what we want to do, it was kind of like a blank stare because I just thought like, I don't even know what to do with this statement, right? So I think that was a high, but that was a high for me, not just because of the award, but when you apply yourself and you stretch yourself to these insane levels and you accomplish certain things, I think that for me, the satisfaction of that accomplishment was really the high. I think the results of that accomplishment are great, but it's really the satisfaction of that accomplishment that was the high. I think another high was when we set up this business, right? A lot of investors, people we knew well, said to us, you're trying to raise an Africa hybrid fund that's fund of funds and direct. And at a time like this, how are you even going to raise more than $50 million, right? They said to us at the beginning. And why would you leave Makena to do this? This is crazy. Makena is $20 billion, right? And so to go from that statement to what we've been able to build, both the farm, the people, the size, the footprint, and the impact we've had so far in this market is definitely high, right? And I think, moreover, we're really just getting started here, I think. So I think those are highs. I think lows, global financial crisis, we definitely hit some lows. I was at Makena when the global financial crisis happened. We had some incredibly stressful moments that I would describe as lows, which were unprecedented for everyone, and we were managing as best we could. I think we came out quite okay, but when we were in them, I would have definitely described them as lows, and they caused us to reflect on investment strategy, on risk management, on the nimbleness of large organizations, how do you pivot quickly during crisis, on how you manage illiquidity for risk premiums positively, and how you manage that on the downside, right, when things go against you. So there are definitely some lows there. And then I think there are some other lows that are just a function of the business we're in, right? So we've had certain portfolio companies, thankfully much, much smaller positions that are either direct or indirect exposures that have had to be written off. And so if you invest in private equity, you always have to remember that it's not just the farm. It's not just this sort of paper thing. It's people, right? You're investing in people who run the farm. Those people have families. You get to know some of those people. And when you have to shut it down, you have to look them in the eye and say, look, we have to shut this thing down. And obviously that could be a very unpleasant situation. Not that it's not necessary in certain situations, but it doesn't make it any easier. So I think you always have to be able to do that with a professionalism and kindness that at the base of it understands that these are people, just like you're a person, right? And so there's definitely been some moments, some lows in there. So I'd say those would be kind of some highs and lows to give you a sense of it.
And when you look at any key people in your career, you mentioned your professor at Swarthmore College. Were there any key mentors for you throughout the course of your career that left an impression? And this does not have to be an exhaustive list, because I know people are concerned there are usually so many. Just one or two names is great.
No, I understand. No, look, I think for me, first, I'm generally a person of some faith, right? And so there are people who are people of faith, people who are not. I am a person of faith. And so God, in my mind, is one of those, it's not really a person, but is one of those influencers, because I've had periods in my life where you could not explain my progress other than some divine intervention. So that's been one big influence in my life. I think in terms of humans, literally humans who've had an influence, I had a maths teacher in grade school when I was 11 to 12, who was he literally walked on water. Like everyone who attended his math class, you started this class and you didn't even know if you liked math or you were failing math. And when you left, you just loved the subject. And he had this ability to take every child who came under his instruction, regardless of background, capabilities, and just convert them into these maths lovers, right? And so he affected literally thousands of people in Uganda. And for me, it was actually a critical turning point in my love of maths. Because before that, I was just another student that, maths was just a subject I took along with other things, right? And so he'd be one important influencer, someone that most people would never have heard about, but who had a huge impact. I think Ray Dalio was definitely an important influence as well. I think most people think of Ray in terms of the visible success that he has obviously had, and lots of people at Bridgewater have had. But I think for me, he was one of those rare examples of people with a high IQ and a high EQ. Because a lot of people in the investment industry typically fall in one or the other camp. They're very smart, but they're terrible with people. They're very good with people and they're okay, smart, right? And Ray, in my mind, was able to combine just this insane focus on excellence, performance, financial performance, as well as a real understanding for people and where people were, and an ability to kind of connect with them. Right? So that for me was a critical influence in my life, in my kind of early years as an investor.
And having had the opportunity to meet with some of these legends, are there any key pieces of wisdom or creed or motto that you now let guide you?
Yeah, look, I would highlight one thing, I think, which I come back to a lot of times, and you'll see this sort of throughout my life, which is this notion that you have to redefine things that are difficult as things that should get done now, and things that are impossible as things that take a little while longer. And that for me has explained a lot of what I've been able to accomplish, which is literally just seeing things differently than people see them and going aggressively after things that most people just consider impossible, right? I mean, it should be impossible for me to come out of Swarthmore, be at Bridgewater and do what I did. It should be impossible for me to have left Makena and set up the business that I have here with partners to build the team here. It should have been impossible for me as a student to raise 3 kids, right? And so this notion that difficult things must get done now and impossible things take a little while longer, I think is probably the one credo motto that is most consistently woven throughout my life.
Well, Richard, that's a great place, I think, for us to bring the conversation to a close. When I listen to you, definitely the phrase of impossible is nothing comes to mind. You have been an extraordinary agent of change throughout your life, from that 12-year-old entrepreneur to the older brother turned guardian. And I've really enjoyed discussing the opportunity in Africa, which I think you've explained so vividly for us here. So thank you for coming and for sharing your wisdom and insights with us.
Thank you for having me. Really appreciated my time here.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.